Good day, everyone. My name is Karin Kamala binti Muhammad Kassi with metric number BG241100406. So today I'm going to discuss about central bank digital currency or CBDC, how monetary policy affect the economy, and how CBDC could influence the transformation of monetary policy. A central bank digital currency or CBDC is a digital form of sovereign currency issued and regulated by a country central bank. Unlike physical cash, CBDC exists entirely in digital forms. It also different from commercial bank deposit because it represents a direct claim on the central bank rather than private financial institution. CBDC is also different from cryptocurrency such as Bitcoin because it's centralized, government-backed, and designed to maintain stable value. The main objective of CBDC are improve payment efficiency, support digital economy, and enhance financial inclusion. The main objective of CBDC are improve payment efficiency, support digital economy, and enhance financial inclusion. Monetary policy prefer action taken by central bank to influence economic conditions such as inflation, employment, and economic growth. Two important transmission mechanisms are interest rate channels and the bank lending channels. This channel helps central bank influence spending, investment, and overall economic activity. The first important monetary transmission mechanism is interest rate channel. This channel explains how change in interest rate influence borrowing, spending, investment, and overall economic activity. As shown in the graph on the left side, when the central bank lower interest rate, borrowing costs become cheaper for the household and business. Because loans become more affordable, consumers tend to spend more, business increase investment, and economic activity expand. This can be seen in the graph where consumer spending and economic growth gradually increase over time and interest rate decline. However, the opposite happens when interest rate increase. As shown in graph on the right side, higher interest rate make borrowing more expensive. As a result, household reduce spending, business delay investment, and overall economic growth are slowed down. The graph clearly illustrates that higher interest rates are associated with lower spending and weaker economic growth. Therefore, the interest rate channel is one of the main ways central banks influence inflation and economic activity through monetary policy. Another important transmission mechanism is the bank lending channel. Commercial banks are responsible for providing loans to households and business. Therefore, monetary policy affect the economic change in bank lending behavior. Under expansionary monetary policy, banks usually have greater liquidity and more willing to provide loans. Increased lending encourage consumption, investment, and business growth. However, during the tight monetary policy condition, banks may reduce lending activity. This limits access to credit and may slow economic growth. The bank lending channel is particularly important in economic where business depend heavily on bank financing. The introduction of CBDC could significantly affect the effectiveness of monetary policy transmission. Because CBDC allow individual and business to hold digital money directly with central bank, policy change could reach the economy quickly and more efficiently. Policy change could reach the economy more quickly and efficiently. For example, change in policy interest rate may directly affect CBDC balance, strengthening in interest rate channel. CBDC could also improve the efficiency of payment system and reduce transaction delays. However, there are also important risks. If consumers transfer large amount of money from commercial banks to CBDC account, commercial bank could lose deposits. This process is known as bank disintermediation. As a result, bank may have fewer funds available for lending, potentially weakening the bank lending channel and reducing credit creation in economy. One of major ethical concerns surrounding CBDC is privacy. Because CBDC transaction digital and potentially traceable, there are concerns that governments or authorities could monitor financial activity too closely. Although the transaction monitoring may help prevent money laundering, fraud, and illegal financial activity, excessive surveillance could threaten personal privacy and financial freedom. Another important concern is financial instability. During periods of economic uncertainty, people may repeatedly transfer money from commercial bank into the CBDCs because CBDCs are backed by the central bank and considered safer. This could increase the risk of bank runs and destabilize the banking sector. Therefore, policymakers must carefully balance financial innovation and security with protection of user privacy and public trust. In conclusion, central bank digital currency represent an important development in evolution of modern financial system. CBDC different from traditional money because it's digital currency issued directly by central bank. Monetary policy affect economy mainly through the interest rate channel and the bank lending channel. CBDC could strengthen money policy transmission by allowing faster and more direct policy effect on the household and firm. However, challenges related to privacy, financial stability, and the role of commercial bank must be carefully managed. As highlighted by Dionysopoulos, Mara, and Eucrat, the success of CBDC will depend not only on the technology advance but also effective regulation, governance, and public trust. Thank you.